Uh, Welcome to today's class. Uh, Today we are going to look at a question, and then we're going to a question on absorption costing. Then you're also going to move to budgeting. So there's this question where RH makes and sells one product which has the following standard production costs. So we have direct labor, 3 hours at 6 shillings per hour, direct materials, variable production overhead, fixed production overhead. Then we have the standard production cost per unit. We have also been told that the normal output is 16,000 units per annum, and it is good to note that this one is per annum. Then you have also been told that the variable selling, distribution and administrative costs are 20% of sales value. Then fixed selling, distribution and administrative costs are 180,000 per annum. There are no units in finished goods inventory at 1st October 2002. The fixed overhead expenditure is spread evenly throughout the year. The selling price per unit is 140 shillings. Production and sales budgets are as follows. So we have a 6-month ending 31st March 2003 and 6-month ending 30th September 2003. So you have been given the production and the sales, and you're required to prepare a profit statement for each of the 6 monthly periods using the following methods of costing. And we have marginal costing and of course absorption costing. There is marginal and absorption. So I think in the last lesson we looked at marginal costing, but you can just go through it so that you can have an overview. Then you go to absorption costing. So for you to be able to work out a marginal costing question or an absorption costing question, you need to know the format of marginal costing and the format of absorption costing, so that you can be able to prepare the profit statement. So for example, for marginal costing, we normally start with the title. RH is the company. Profit statement for the period ending 31st March 2003. So the first what do you call it? The first 6 months. So 31st March 2003. That is the profit statement that you are preparing. So it means that you are going to use a production of 8,500 and a sales of 7,000. So what we normally do, we start with the sales, and the sales in this case is 7,000 according to 31st March 2003. So the sales is 7,000. But now these are sales, production and sales budgets are as follows. So these are sales in form of units. But now if you want to get sales in shillings, the selling price per unit is 140 shillings. So what are we going to do? 7,000 times 140, so that we get the sales in form of money, because you are preparing this profit statement in form of shillings. So we convert the units to money. So 7,000 times selling price per unit, it means that we will have 980,000. Then according to marginal costing, we are going to subtract the variable cost, and you're going to start with the opening costs. In this question, we have not been given the opening stock. So our opening stock is a dash. Then from there we write the variable cost. Sorry, we have the direct labor. So you come here, direct labor is 18 shillings, direct materials is 28, then we have variable production overhead at 3 shillings. So those are the variable costs. So direct labor is 18 shillings, but now the production, so we multiply by the production. Production is 8500. So we say 18 times 8500, so that we can know the labor that is required to produce 8500 units. So our direct labor is 18 times 8500. Direct materials is 28 times the same 8500, that is the production. Then variable production overheads is 3 times 8500. Then you add. That means that the variable cost will be 416,500. That is the variable cost. From there, according to the format, we normally subtract the closing stock. And in this case, our closing stock, we normally take this 18 plus 28 plus 3 for us to have 49. 18, the direct labor, the variable cost that we have 18 plus 28 plus 3 for us to have 49. Then in this case, we have a closing stock of 1500. Where are we getting 1500? If the production is 8500, and then so we produce 8500 products, then we sell 7000. It means that at the end of that period, we will have 1500 as our closing stock for that financial period. So here we will have 1500. So that means that our closing stock will be 1500 times 49 for us to have 73,500. Then you subtract. You less the variable cost for us to get contribution. From there, you're going to less variable selling and administration according to the format. So the variable selling and administration costs, variable selling, distribution and administrative costs are 20% of sales value. So what do? You take 20% of the sales value, 980,000, for you to subtract and for you to get 196,000. Then you subtract contribution minus variable selling and administrative costs. Then you'll have the total contribution. From the total contribution, we normally subtract the fixed cost. And fixed cost in this case, we have two. We have fixed production overheads and fixed selling and distribution. For fixed production overheads, we normally take the normal output, which is 16,000. And it is good that you know the fixed overhead expenditure is spread evenly throughout the year. So that means that this 16,000 is for the whole year, but we want for the we want the fixed overheads for the first 6 months up to March, 6 months ending 31st March. So what do? So we have the normal output and the fixed production overhead is 20 shillings. So we are going to say 20 times 16,000 for us to get the fixed production overheads in shillings, and then we are going to multiply by 6/12. So fixed production overheads, we take the fixed production overhead in shillings times the normal output in units times 6/12 for the first 6 months for us to have 160,000. For fixed selling and distribution costs, fixed selling, distribution and administrative costs are 180,000 per annum. So this is 180,000 for the whole year. but we want the fixed selling and distribution cost for the first 6 months. Therefore, we are going to say 180,000 for the whole year times 6/12 for us to have 90,000. From there, we subtract the total contribution minus the fixed cost for us to get the net profit. And this is the answer for the first 6 months. Any clarification about the marginal costing? Yes, you can carry on. Oh, welcome. You're most welcome. So we can proceed to marginal cost for the second part, which is the next 6 months. So we still do the same. Here I've not written the heading, but it's good that you write the heading. So we are going to start with the sales. Sales in this case, we have said that we are going to use 8,000. So this is the next 6 months. So the sales is 8,000, but the selling price per unit does not change. It is 140. So we are going to say 8,000 times 140. This one, 140 times 8,000, you will have this. Then we subtract the variable cost. But in this case, we have an opening stock, not like the other case. So here we have an opening stock of 1,500. Where are we getting the 1,500? You see, the first 6 months, we had a closing stock of 1,500 because we produced 8,500, but we sold 7,000 units. That means that the closing stock for that financial year is 1,500. That 1,500 is our opening stock for the next 6 months. So that 1,500, the closing stock for this is the opening stock for these other 6 months. So that means that if that is the opening stock, or let me just consider it as the 1,500 as the opening stock. So the closing stock for the first 6 months becomes the opening stock for the next 6 months. And then for the opening stock, we are still going to multiply by 49. Where are we getting this 49? It's the variable cost. Direct labor is 18 times 7,000. 7,000 is the production, this one, the production. So for the variable cost, we multiply by the production. So 18 times 7,000, 126,000, 28 times 7,000, 196,000, 3 times 7,000, 21,000. Then you add. So this 18 direct labor plus 28 plus 3 becomes the opening stock, and it also becomes the closing stock in form of shillings. So for the closing stock for the second half, it will be different. Here we have our closing stock or closing inventory as 500. Why are we saying that it is 500? Because if we have 1,500 as our opening stock, then we were able to produce 7,000. So that means that 1,500 plus 7,000 is 8,500, the opening stock. So it means that we started that month, let's call it financial month, we started with a stock of 1500, then we produced 7000. It means that now we have a stock of 7000 plus 1500. Then we sell 8000. It means now that our closing stock will be 500, because it will be 8500 minus 8000. So our closing stock in this case will be 500. That is why we have 500 times 49. 49 is the same as 18 plus 23 plus 3. Then you get that as the closing inventory. So you're going to take the sales minus this, that is the variable cost, for us to get contribution. Then you're going to subtract the variable selling and distribution. The concept is the same. You take 20% of the sales, you get that. Then total contribution is 5 or 4,000. Then you're going to subtract the fixed cost. We have fixed production overheads, whereby we have said that you're just going to take 20. So the fixed production or the fixed cost remains the same. We take 20 times 16,000 times 6 over 12, because this one is per annum. Also for the fixed selling, distribution and administrative cost, it is 180,000 per annum. So you're going to take 180,000 times 6 over 12. So that's why we have fixed production overheads as 20 times 16,000 times 6 over 12, then 180,000 times 6 over 12. Then you subtract for us to get the net profit. And that is how you're supposed to calculate a marginal costing question, or calculate profit using marginal costing approach. So unless there is a question, I would like to proceed to absorption costing method. We just look at the first quarter. Then now I introduce budgeting. Okay, if it is clear, let's go to absorption costing. So you can be told to use absorption costing method to calculate profit. So what you do, you take RH, that is the name of the company. We are using absorption costing method, profit statement for the year ending 31st March 2003. So this is the first 6 months. You're going to start with this one to calculate absorption costing. So for absorption costing, the format, we have sales. You're going to start with our sales. Our sales in this case still remains. So we have a sales of 7,000. Sales times selling price of 140, of course. So 7,000 times 140. We have 980,000. Then you less cost of sales or production cost of sales. Opening stock. So we still don't have the opening stock. So we are not going to use it. So then we proceed. Direct labor 18 times 8,500. So you come here. 18 is this times the production. So we're going to say 18 times 8,500, 28 times 8,500, 3 times 8,500. And for absorption costing, we're also going to consider the fixed production overhead. So we are using 8,500 because it is 31st March, so production is 8,500. So we will have 18 times 8,500, 28 times 8,500, and 3 times 8,500. The difference between marginal costing and absorption costing is that we are going to account for fixed production overheads here. So in marginal costing, fixed production overhead was not here, but in this one, absorption, we are going to consider fixed production overheads. So the fixed production overhead was 20 times 8500. Then you add, subtract the closing stock. So the closing stock remains to be 1500. The only difference is that here we are going to multiply by 69. For marginal costing, we were using 49 for the closing stock, but here we are using 69 because the direct labor in shillings per unit is 18. So we add 18 plus 28 plus 3 is 49, then plus the fixed production overheads, which is 69. So in that case, this is the 69 that we are using. 18 plus 28 plus 3 plus 20 is 69. So in absorption costing, we are going to use 69. So that is something that you should also consider and be keen while you're writing that. So we subtract the closing stock for us to have 483,000. So also in absorption costing, we are going to consider what is called over absorption. And when there is an over absorption, we normally do what? Subtract. So what is over absorption? So when we take the 20 for the fixed production overheads, so 20 times 8500, 20 is the fixed production overhead, this one, 20 times 8500. So you take 20, which is the fixed production overheads, times 8500, you get 170,000. Then you take the actual production overheads. So remember, we have this one, and we also have the normal output. The normal output is 16,000 per annum. So you take the normal output that you are given times the fixed production overheads. So it is 16,000 times 20 for us to be able, then you're going to multiply by the 6 months, 6 over 12, so that you can be able to know what is called over absorption. So the difference between the two, but I'd like you to do more research on over absorption and under absorption using absorption costing. So but that is how it should be done. You take 20 times 8500, 8500 is the production, then you take 20 times the normal output, then times 6 over 12 because it is for the 6 months. So this 10,000, when there is an over absorption, we normally take that 10,000 and subtract from the from this 483,000. So minus 10,000 for us to have 473,000. And from there now we can take the sales, 980,000 minus 473,000 for us to have the gross profit as 507,000. So our gross profit in this case is 507,000. Then you're going to subtract. So for absorption costing, you normally subtract non-production costs, which are variable selling, distribution and admin expenses, and fixed selling, distribution and admin expenses. For variable selling, distribution, that one is given. Variable selling, distribution and administration expenses are 20% of the sales value. So here we're just going to take 20% of the sales value. Then fixed selling, distribution and admin expenses are 180,000, and note that this one is per annum and we are dealing with the 6 months. Therefore, we are going to say that variable selling and distribution expenses or cost, it will be 20% of the sales, which is 980,000. Fixed selling, distribution and admin will be, we were given 180,000 per year, So we just say 180,000 times 6 over 12. Then we subtract. From there, we get what is called the net profit. So unless there is a question on that. Okay, there is no question. I would like you to try out the absorption costing for September. I've realized that it's not here, but I think I can also look for it. It must be somewhere. So that we can proceed to what I had prepared for us to look at today. We want to go to what is called budgeting, and you're going to start with what you're calling a cash budget. And then you're going to look at the other different types of budgets. We have flexible budget, sales budget, purchases budget, but you're going to start with cash budget. So in a cash budget, we normally have cash flow. We normally record cash flows. For cash flows, I mean cash coming into the business and cash coming out of the business. So we record cash into the business and cash out of the business, cash flowing. So we will use an example so that you can be able to understand what normally happens in a cash budget. The following information was extracted from the books of Box Limited, a company which started trading 1 year ago. So we have month, we have sales, and we have purchases. So in the year 2007, we have April sales is 150,000 and April purchases. So I've told you that in a cash budget, we normally record cash coming into the business in terms of sales. Cash normally comes into the business when we do sales. We also have purchases. Sometimes we buy goods into the business, therefore we spend money. So that one we say cash is moving out of the business, cash outflow. So we are recording cash into the business, cash inflow, and cash out of the business, cash outflow. So we have the month of May, where we are making a sales of 160, purchases of 110. We have June, July up to December. These are the sales that we were making, and these are the purchases that we had made. Then we have been given some additional information. The following additional information is available. Part A, cash in hand at the end of May 2007 will be 180,000. So we are told that in May 2007, as much as we made a sales of 160,000, the cash that we had in hand is 180,000. Then tunaambiwa 60% of the sales proceeds are received in the current month. 60% of the sales. So for example, in April, if we made a sales of 150,000, 60% of these sales, that money, 60% of 150,000, is going to be received in the month of April. So that means that 40% will not be received in that month. So we are told 60% of the sales proceeds are received in the current month, 30% in the following month. The balance is received in 2 months after sales. So the balance is 60 plus 30, 90. So the balance is 10%. So that means that 60% is received in April, 30% of 150,000 is received in the following month, which is May. 10% of April sales will be received in June. That is what it means, but you're going to calculate and see. Part C says suppliers are paid 1 month after delivery of goods. So they are paid 1 month after delivery of goods. That means that if they are paid 1 month, if we make purchases in April, of course we are making some purchases from our suppliers. That means this 100,000, we will not pay it in April. We are going to pay in May, 1 month after we receive the goods. So if we purchase an item or items worth 100,000 in April, we will pay them the following month, which is in May. Corporation tax for 2006 amounting to 20,000 will be paid on 30th September 2007. So for tax, we are going to pay on September. Contractors' retention monies amounting to 50,000 will be paid on 30th June. So we have contractors' retention money, which will be paid on 30th June. The shareholders at their last extraordinary general meeting increased the share capital by 70,000, and the first call of 40,000 will be received in 2007. So there is an amount of money here that will be received in October 2007. Then we still proceed. In October 2007, the company is due to receive 20,000 as compensation for a civil suit. Then the monthly administration expenses amounting to this include factory depreciation charge of 4,000 and preliminary expenses of 3,000. Office equipment worth 13,000 will be paid in November 2007. You are required to prepare a cash budget for the period 1st June to 31st December 2007. So you're supposed to prepare a cash budget for the period of 1st June. So as much as we have details for May, for April, May, so we are not supposed to prepare a cash budget for those months. We are starting from June to, is it November or December? December. So we are preparing a 6 months cash budget. When you get such kind of a question, this question is normally very interesting and very easy. You must come up with a table and the heading is a cash budget. So we are supposed to prepare a cash budget from the month of June to the month of December. Ensure that you have written all the months: June, July, August, September, October, November, and December. 6 months. You are supposed to prepare a cash budget for 6 months. In a cash budget is very interesting. It just has 2 aspects: receipts and payments. Here we record the money that you have received, and here we record all our payments, and then here we record the balance. So I'm saying that a cash budget is very interesting because you are writing all the monies that you have received here. That is why we have receipts. Then all the payments that you have made: payment to this person, payment to tax, payment to this, we record them here. Then from there we can now start our making entries in our cash budget. The first thing again that you start with under receipts is what we call BAL B/F. BAL B/F or B/D means balance. This is balance brought down. So any balance from the previous month, we are going to record them here. So any balance. So we are going to start with the month of this, something that you had been told. Cash in hand at the end of May 2007 will be 180,000. So this cash in hand at the end of May 2007 will be the opening balance in the next month. So May, June. So this 180,000 will be our balance, our opening balance in the month of June. So you write the balance here. All the balances from the previous month. So after we make our sales and we make our purchases, there is a balance that will remain, if it will remain. So that balance is what we record here under the balance brought down. This is balance from the previous month after we make sales and we make payments. Okay. So from writing the 180,000, then we proceed to think part B is the longest. Yeah. So 60% of sales proceeds are received in the current month, 30% in the following month, and the balance is received 2 months after sale. So here you really have to do calculations, because if we are starting with the month of June, so 60% of 160,000 is made in the month of June. So let me see. Yeah, good. The good thing is that I have this with me. So this is what you do. Part B, receipts from sales. So 60% of June sales, and June sales is I have to go back again. So 160, yeah. So June will have 60% of 160, which will be that. Then remember, also in June, we are going to receive money from May, from the previous month. That is 30% and 10% from April. So what is happening here? So in April, 60% will be received in April. Then 30% of 150 will be received in May. Then 10% of April sales will be received in June. That is why we are saying 10% of April sales will be received in June. That is something that you are supposed to be very keen. Then in July, 60% of July sales will be received in July. Then 30% of June sales will be received in July. Then 10% of May sales will be received in July. So that is what you should be keen on. 60% of July sales, yes, 30% of June, then 10% of May sales, then you add. Then August the same, 60% of August sales, 30% of July and 10% of June, then you add. September, 60% of September sales, 30% of August sales, then 10% of July, you add. So you're going to consider all those sales up to November. November, we have 182,000. So all this money that you're receiving, we are writing here. Receipts from sales. Receipts from sales. So in the month of June, we are going to write 159,000. The month of July, 166,000. Actually, you're supposed to calculate up to the month of December. So the month of November, we have 182,000. That means that the month of December is 192,000. I hope this is clear. This is where we normally have issues. So if there is no question, we proceed with, yes, Andrew? Yes? Mm-hmm. Mm. Yes, thank you for that. Also, we can see Mary, you have asked the same question. So, let me explain. But I'll explain after we finish the June entries. Because for balances, um, you just take the total receipts. So the total receipts for the month of June will be 339,000. Then the total payments 186,000. Then you say 339 minus 186. 153 is the balance carried down. That is the balance in the month of June, which becomes the opening balance in the month of July. I hope that is clear. Okay. Then this same balance in the month of July becomes the opening balance in the month of August. You can see 203,000 to 3,000. 274,000 becomes the opening balance to 74,000 in September. 345,000, 345,000 in October. Up to the last let's say in November, we have for 40,000, which becomes the opening balance in the month of December. Just that. So from there, now we are just making entries, and you can go to now part C. So suppliers are paid 1 month after delivery. This one is a bit easier because all the payments we are recording them here. So here we are paying to creditors or payments to suppliers. So 1 month after delivery, that means that if we purchase goods in, so if we purchased goods in April, we are going to pay in May. So May we will pay 100,000. June we purchased 110, we pay in June 110,000. So that means that payment in June we will start with 110,000, then 90,000, then 90,000. So like that we purchase 100,000, we pay it in May. So that means that in June we are going to start with payment in payment to creditors 110,000. Then you proceed like that up to the last month. That is for part C. Part D, corporation tax will be paid. So for payments, we record them under payments. So 30th September 2007, how much? 20,000. We are going to pay a tax of 20,000. I've written it under October. Hope it's October, not September. September. 30th September. How comes I've written it under October? Oh, payments, yeah, thank you. Thank you for that. It's under payments, yeah, because it is tax. So we are paying tax, corporation tax. Thank you for that. So under September. Yes, September. So that is another payment. Then we proceed to next part. So you can be cancelling. So once you are done with part A, you cancel part B, part C. So we are done with part D. Part E, retention. Contractors' retention money amounting to 50,000 will be paid on 30th June 2007. So there is a 30th June, there is a payment to be made. That one is under payments, retention money. So, and you write it under the month of June. So you write it there, then you cancel it. That is for part E. Part F, the shareholders at their last extraordinary general meeting increased their share capital by 70,000, and their first call of 40,000 will be received on October. So here we are receiving money, that is 40,000 in the month of October 27. So October, there's this 20,000 that is being received. So you write it under receipts. Kwani nimechoka leo. Thank you. Nimesema 20,000, 40,000. Yes, 40,000, sorry, 40,000. Then, that is 40,000, yes, thank you. In October 27, the company is due to receive 20,000 as compensation for a civil suit. So there is 20,000 that you are receiving in October, receiving. So any money received, so there is this compensation received, the month of October, 20,000. So you write it there. Then we proceed. What else are we receiving? The monthly administration expenses amounting to 33,000, including factory depreciation charge of 4,000 and preliminary expenses of 3,000. So this depreciation, we are going to subtract so there is payment of administration expenses. So, and for cash budget, we don't consider non-cash items. So like depreciation is a provision, so we don't consider it as a cash inflow or a cash outflow. Also, preliminary expenses are not considered as well. So we are going to say 33,000 minus 4,000 minus 3,000 for us to be able to know what we are going to make in terms of payment of administration expenses every month. Preliminary expenses are expenses that are incurred before the company is created. So those expenses, we cannot be paying for these expenses every month as preliminary expenses. So that's why we are going to subtract 33,000 minus 4,000 minus 3,000 for us now to have the administration expenses. So every month when you subtract, the payment that will be paying as our administration expenses is 33,000 minus 7,000, which I hope will give us 26,000, and we will be paying monthly. Every month we will be paying admin expenses of 26,000 every month. What else is remaining? Office equipment was 13,000 will be paid in November. That is a payment of office equipment. Office equipment we are going to pay in November. Hope I've said 18,000. 13,000. So here there is need for a correction, but I think it's an error, a writing error, because 140,000 plus 26,000, 179, yeah. So this one should be 13,000. I wrote 18 instead of 13. I think I was in a hurry. So here it's 13,000. So after you do that, now you're done with the cash budget. You just get the totals for receipts, total. You get all the totals and you underline for receipts. Actually, you can't get the total when you don't have the balance. So the first thing is to calculate the total receipts for the month of June and total payments. Then you subtract 339,000 minus 186. You get this so that you can fill in the balance brought down for the month of July. July, do the same. Then you proceed up to the last month. And this is how you prepare a cash budget. You can be told to prepare a cash budget for 4 months, for 6 months, for the months that you're supposed to prepare. The most important thing is that you know a cash budget has receipts and payments. And all the receipts, you record them together. All the payments, you record them together and remember the balances. And then you're good to go with the cash budget. Unless there's a question about a cash budget or clarification. Okay, if there's no question about a cash budget, thank you so much for your time. I don't know when you can create time so that we do extra lessons for financial management.